Hey, it's Jim, and this is level 3 of the CFA program, the topic on private wealth management, and the reading on topics in private wealth management. And this is part 2 of 3 parts. Let me just remind you quickly that back in part 1, we addressed the LOSs that had the word tax in them. And let me also remind you that we did some calculations. So even though none of the LOSs ask us to compute or calculate, there's two in there that asked us to analyze. So you will have to do some calculations. Now we're going to move on to concentrated portfolios. And the reading is really interesting in its description of these concentrated positions, in that the reading indicates that there really are no hard and fast rules like there are in many aspects of finance. Remember in the Harry Markowitz, the portfolio, it's either inefficient or unattainable or efficient. Here, the reading suggests that it's up to us to decide which portfolios are concentrated and which are not. Let me give you just a quick example. This is taken right from the reading. The authors suggest that it is possible that a total position of 10% in a small cap stock might be considered a concentrated portfolio. And there are some other factors that we'll consider here in this slide deck. But a 10% investment in large cap dividend paying stocks is probably not a concentrated portfolio. And then in the very next sentence or so, this is where the Institute says something like, you guys figure it out, and what they probably want us to do is err on the side of caution so that we can utilize all of these strategies that we'll talk about here inside of these, just 4 LOSs here in part 2. So let's go ahead and start with this concentrated single asset positions. So how can these things arise? Usually they're from an initial public offering. They're from employees who receive company stock. It's usually from high net worth investors whose individual or family owns a business, or maybe they own some real estate. And so you have these concentrated positions that need addressing. Notice that second arrow point, not straightforward, determining what constitutes this. But it depends on factors like low tax basis, emotional attachment with a client. That's especially true for inherited assets. It's especially true for family-owned businesses. And look at that bottom blue arrow point. So what's the problem with concentrated portfolios is that they're probably not efficient. In fact, there's probably no way that they're efficient. And that's mostly because that they're not diversified. Look at the bottom. Advisors play a critical role. So these next 28 or 30 slides are an outline for us to play that critical role. So let's address this LOS about risk. How do we identify those risks in these concentrated portfolios? So we need to worry about company-specific risks. So this would be more important for employees who work for the company and have shares in that particular company. Let me give you the quick example. Are you guys old enough to remember Enron? There was huge Wall Street Journal articles about employees at Enron that used Enron stock for their retirement portfolio. They used Enron stock for their lifetime portfolio, and they generated income in shares of stock, not to mention a salary. So when Enron went from 90 some dollars down to $1 or 50 cents, whatever it was, those individuals, they lost their retirement, they lost their lifetime savings, they lost their job, they lost their salary. So that's that unsystematic risk that we've talked about in level 1 and level 2. Look over in the green box, there's the lack of diversification. Just always think of Harry Markowitz. So you have this efficient frontier, and this concentrated position is going to be somewhere down in the inefficient region. And then, of course, now with Enron was not, it was a big company, so there wasn't liquidity issues with it. But with the owners of a business, suppose a family owns, 15 miniature golf courses along the east coast of the United States, and they're worth, let's say, oh boy, I wouldn't even know how much they're worth. Let me pick a number, 10 million, 15 million. Maybe they're worth 100 million. So these are pretty illiquid assets, so we need to consider that in terms of addressing the lack of diversification. And then, of course, if we do sell it, then you have to worry about a huge tax liability. I mean, think about some of these miniature golf courses were bought with land 100 years ago. So maybe they paid $10,000 for that miniature golf course, and now all of a sudden there's condominiums and houses all over the place, and it's worth I don't know, what could it be worth, $1 or $2 or $5 million? So huge tax liabilities there. All right, here are some of these factors that we need to consider. So level of concentration. This is why I think that the reading mentions the 10% in small cap and the 10% in large cap stocks. And so, sometimes 10% will be concentrated, sometimes 10% won't be concentrated. It's up to kind of figure out what that position is. So we'll need to address some of these other factors like a tax basis and a tax rate and liquidity issues, time horizon, restrictions. I always say this to my students when I teach them about equity swaps. When you have an executive for a company that is required to own a minimum number of shares, maybe it's 10,000, maybe it's 100,000 shares, how do you address that? It's required by their employment contract. So they can't sell. So one of the easiest things, it's easy, it's risky, it's easy to do, is to engage in an equity swap. And then non-financial considerations. They're the emotional attachments. Let me go ahead and warn you that this is a great place for the Institute to go ahead and combine all of that stuff that we talked about in behavioral finance. Remember, cognitive errors and emotional biases. So this would not be a cognitive error. This would be an emotional attachment to the miniature golf course. Let's suppose you're 50 years old and your parents own the miniature golf course and you grew up playing it every day. And the wealth advisor comes and says, oh, you ought to sell this. And you think, oh my gosh, you remember that putt I made when I was 7 years old? I had 6 hole-in-ones in a row or something. So emotional attachments can be super obstacles when trying to diversify portfolios. All right, so once we consider those factors, then, how do we approach this? Well, the easiest way is just to sell this concentrated position and then buy some other stuff, right? Invest in a diversified portfolio. What you can do is you can sell and diversify, but you can do it over time. So we call that phased selling, multiple tranches over time. Hedging and monetization strategies. This is really cool. This is what I was hinting at just a minute ago about using equity swaps, but you can use almost any derivative here to monetize this position, to hedge this concentrated position. And sometimes you can use a loan. So don't forget to add the extra leveraged risk or the default risk or the third-party risk or just the general credit risk when you're using a loan to secure this hedge position or the monetize strategies. Some countries will allow you to, and let's go back to my example, they'll allow you to sell the miniature golf course for $1 million or $2 million and use those proceeds to go to the New York Stock Exchange and buy shares of stock. So that could be a tax-free exchange. You can also transfer the assets into some tax-exempt account, like a charitable trust, without incurring any kind of a tax liability. And then there are tax avoidance and tax deferral strategies. We talked about those back in part 1. So here's a good example here, risk and tax-related considerations. So we have Jane, 75% of her portfolio consists of the company shares. They've appreciated significantly, now valued at $30 million. All right, so there's a ultra high net worth client. Controlling ownership, 55% in her brother's private startup. So think about what that means. Whatever her brother's doing in this startup, there are tons and tons of extra risk. So you can't just limit it to systematic and unsystematic risk and default risk and credit risk, whether this 55% would be in the equities or fixed income securities. You got to add all that other stuff in there for a private startup. So it approached the financial advisor. And so what's our question here? Which are the potential risks and tax considerations? All right, so we identified two concentrated positions, the company shares and the private startup shares. Portfolio, there's no way it's efficient. There's no way that it is diversified. And so it's company-specific risk, efficiency reduction, liquidity risk. Clearly, the HKM Capital, let me go back here. We don't really know anything about. It's publicly listed, but we don't know if it's a large cap or a small cap. We don't know if it's traded on the New York Stock Exchange or if it's traded over there on, Jim's mini exchange. So we probably don't know much about liquidity, but we could probably, if we knew more information, we could make a judgment on liquidity. And then that tax liability, what did we say? Those shares are now worth $30 million. There's the extra risk that I was talking about with the startup. So operating history, just brief, business mix is probably not diversified. Yeah, access to financing. So you can imagine the brother coming to, what's this person's name? Jane. You could probably imagine the brother coming and saying, hey, Jane, I appreciate your 55%. How about 75%? Considerably riskier. That makes sense down at the bottom. All right, staged diversification. So we have this concentrated portfolio in the circle over there. What we're going to do is we're going to chop it into little pieces of the pie, and we're going to, this was, what did we call it earlier? The phased selling. We'll just call it staged diversification here. It's the same kind of concept. But the important point here is that we're going to spread out that tax liability. So, in this example back here, where was I? Suppose Jane just suddenly quit her job, and so we have this $30 million. We don't want to sell it all, so to pay that entire tax liability today, we want to chop it into different pieces of the pie. And so, think of those pieces of the pie on a timeline. So the red piece of pie is year one, the green piece of pie is year two, et cetera, et cetera. And then, of course, look at the bottom arrow point. So we take that little piece of pie, and then we go to the New York Stock Exchange, and we invest in a diversified portfolio. Now, what happens if you have some emotional attachment or some contractual attachment to this concentrated portfolio, and it's really not in the best interest or reasonable to sell? Well, what we do then is we come up with this what the Institute calls a completion portfolio. I think I've heard people call it a complementary portfolio. What we do is we take an index-based portfolio like the S&P 500 index or the Wilshire 5000, and we use current income or current savings to add to that. So think about this, here's the concentrated position, and then here's our little index portfolio. So over time, that index portfolio grows, and who knows what the concentrated position does. Maybe it grows, maybe it shrinks, but then you have these two circles here instead of one giant circle and one tiny circle. And so what we're trying to do here is we're trying to probably use some kind of a tax optimization software that we talked ever so briefly about back in part one. But look at that fourth bullet point there. I like this as a potential exam question. Keeping in mind that the Institute, they love us to monitor our portfolio, so they want us to do that, and they want us to be worried about rebalancing, and so we're going to minimize tracking error and maximize after-tax returns. So that makes perfect sense. How do we do this? So look over at the balance over on the side. We've got these taxes and tracking error. So this is really just a marginal cost, marginal benefit kind of a scenario. We want to make certain that we don't have a massive tracking error. Let me just go back here. Where was I with my concentrated portfolio, and then this complementary or completion portfolio? What about the correlations between those two? We want to make certain that that tracking error in our portfolio is not too large, right? That makes perfect sense. Here's what I was talking about with equity monetization just a few minutes ago, restrictions on the sale of assets. So I mentioned those. what we don't want to do is give up the voting rights. We might need to worry about some kind of cash for short-term expenses. And so this is what we're going to do with it. Look at the bottom here. So we can sell a security, we can sell a forward contract, we can enter, well, there's a total return equity swap that I mentioned earlier. So we can hedge, look on the left-hand side up at the top. We can use these derivatives that we've talked so much about in level 3 and in level 2. And especially true because, there's derivatives for almost everything out there these days. And then over on the right side with the green, we can use leverage to make this monetization process even more efficient, but we need to worry about the extra risk as well. Yeah, this is interesting here. I was a little surprised that the Institute was going to tell us to go ahead and put together a collar. We did collars back in level 2. So remember what any kind of a collar is. We're going to use two different kinds of options here. We're going to buy a put, and the exercise price on the put is going to be A down there, and then the exercise price of the call is going to be B. And so that hits the those little break points there. So that's the collar. Essentially, what we're doing is adding a covered call to a protected put. So we're buying the call and we're going to sell the put. A lot of times it ends up being a zero-cost collar. And you might remember hearing this term that I used before. Boy, for it to be a zero-cost collar, that the income that you generate from selling the call has to be the same as the premium that is required to buy the put, zero cost collar. But you might remember this term that a lot of these are not zero cost collars, but nearly zero cost collars. I don't imagine the Institute would use that term on the exam. But notice the very bottom teardrop point does not eliminate the risk entirely. But what it does is it provides that, that upper boundary and the lower boundary. You remember all the stuff that we talked about from collars there. Now, of course, we're selling something and then we're buying something here. So we need to make sure that we handle this appropriately in the taxes. So look over on the right-hand side. The premium paid, this is not some kind of a tax event. But the premium received, that's known as a capital gain. So we need to make sure that we keep track of which options we're buying and which options that we're selling. And of course, this applies all the way back to, let me go back up here, look in the top left there. So there's options. We can do forwards, we can do futures contracts, we can do a total return equity swap, we can do any other kinds of swaps out there. We can use a credit default swap. I mean, tremendous amounts of choices that we can use. But remember, I say this regularly, the Institute is not asking us to be tax lawyers and tax accountants, but they do want us to know what is this potential tax liability. Remember, we did that ratio back in part 1. Covered call writing. So what does this mean? We know this from level 2. We own the stock and we're going to go ahead and write a call option. This is part of this tax optimized equity strategies. I mean, what happens here in a stable market, suppose that the stock price stays somewhere around the exercise price. So what happens then is that we get to keep the premium, but we have to report that as income. But if the stock price appreciates, well, then what do? We had already agreed to sell it at a certain price. And so then somebody else gets to pay that capital gain and we don't have to do that. Here's a nice slide on tax-free exchanges that I was talking about earlier with the selling the miniature golf course and going to the New York Stock Exchange and buying some shares. You can do this a variety of ways. Make certain that you read in the question stem or the vignette that whatever country the client is living in, that this is a tax-free exchange or this is appropriate for this kind of an investor. What are some interesting things about here? Low basis securities. And so this makes perfect sense. When we exchange one for the other, there's a pro rata share, especially if we form this new fund, we'll call it a newly formed fund. And there's probably some time constrictions on this. Look down at the bottom there. We say 7 years. I mean, different countries have different time periods. There are probably redemption fees if this fund, if you try to withdraw early from this fund. And so you think about this. It's almost like, well, I don't even want to say this, but it's almost like a mutual fund. It's almost like a hedge fund. I mean, they have similar qualities, but remember now, the important focus here is not the focus of mutual funds or hedge funds, but tax-free exchanges. Charitable remainder trust, just look down at the bottom, purple and green box. This is exactly what you need. You put some assets into this trust, and what happens is that the named beneficiaries would pay the income tax, and then upon death, then the beneficiary receives that asset. And what happens then is if you put this, let's go back to my miniature golf course example. You put the miniature golf course in a CRT. What did I say? It was $2 million. So we might get a $2 million tax deduction, or we might get a $1 million tax deduction, or we might get a $10,000 tax deduction. Of course, it depends on that country's rules about the tax deductibility of charitable donations. How about this example of privately owned businesses? I'm guessing that you have either friends or acquaintances, or in your city of a family-owned business that has been around for a super, super long time. So how do we manage these businesses that are cross generations, that probably have tons of capital gain potential tax liabilities in there? You think about this. I bet you can find an example in your local community where, suppose you have a third generation who's running the business. So their grandmother or their grandfather started this business, pick a number, 70 years, 80 years ago or so. And so you can imagine, these really, really smart businessmen and women, they just started this business. They worked really hard. They plowed all their profits back into the business. When they had some extra money, they probably bought some land around, around the area, and then they could lease the land and they could develop it. And, and so the businesses, then they kind of add on top of each other. One of the issues there is liquidity. How do you handle this? Because the business is generating an income, and so maybe the family members are paying themselves a salary. But suppose they want to go and build a house in the Cayman Islands for $10 million. Well, maybe they don't have $10 million, and I mean they could go to the bank and borrow it. So how do we handle all this stuff? Notice in that first diamond point, the net worth is tied up in their business. Yeah, so what are some things that we can do? We can go ahead and sell, all of the assets or some of the assets. Notice at the bottom box, sale to a third-party investor, sale to an insider. We can sell some of our non-core assets. We can do some leverage there at the bottom, so personal line of credit, leveraged recap, or up the top left, we can go through an initial public offering. So those are sources of liquidity, and then we can do if we have an employee stock ownership plan, we can also do that. So think about tax liability, think about the loss of control, think about the dilution of ownership. And so this is exactly what I talk about lots of times. This is the marginal cost of generating liquidity versus the marginal benefit of generating liquidity. And so I'm guessing that family members are probably willing to give up a little bit of ownership to have that $10 million house in the Cayman Islands. So what kind of questions is the Institute going to ask? And I'll tell you, this is the very first question at the end of this chapter. Choice, I can't remember the choices. One was a leverage recap and one was a personal line of credit. The correct answer is the personal line of credit secured by the company's shares. But you already know that, because didn't I tell you to go do that at the end of part one? Did you also listen to George Harrison and the Tax Man? I bet many of you did. All right, here's personal line of credit. So we know what this is. We just take either the assets of the business or the equity of the business and use that as collateral for a personal loan. And there are all different sorts of arrangements. Now, as you read through this slide, the Institute is not asking us to be lawyers or legal experts, but they do want us to know what the tax event is for the business owner in obtaining this loan. So, we've got interest paid is probably going to be tax deductible. And that's probably the most important part of this. There it is in the very bottom circle point. A leveraged recapitalization. Of course, that term leverage means some kind of debt. So what can we do? We can just go out there and borrow money. Maybe we use some type of collateral. Maybe we just, do something else. A lot of times this can go through a private equity firm. It doesn't have to, but a lot of times it does. And so we go ahead and borrow money from somebody else, maybe a private equity firm, and we generate that liquidity. And in return, we give some ownership to that private equity firm. Now, when we deal with private equity, it probably comes a little bit more complex, especially when that private equity firm says something like, you know what, we're happy to lend you some money. We'll take some part in the ownership and the profitability of the company. But after 3 years or 5 years or 7 years, we want out. So we need to make certain that we have enough cash to be able to have an exit strategy. We need to make certain that the taxes that we're going to be owed today and then owed at that exit strategy, that we know all of this stuff here. Now, a lot of firms have an employee stock ownership plan, and so it's possible then that the firm has a policy under which it will buy back shares of stock of the business owner, and then it can hold on to those, but it can distribute those shares however it wants. And that way the owner generates some cash. So it's kind of like borrowing from the company, but it's not a loan. It involves shares of stock. Real estate, think of my miniature golf course example. So environmental liabilities. And the reading goes to great lengths to have us be concerned about a loss of a major tenant or the loss in value because of several things. Maybe it's zoning laws, maybe it's environmental liability, but the theme here is that we can have this concentrated portfolio. I mean, imagine that we have a commercial real estate building, and it's 2 floors, and in 95% of the 2 floors is one business, and then in 5% there's another business. So if we lose that 95%, I mean, that sounds an awful lot to me like a concentrated position. So it's probably illiquid, and so we need to make certain that we can diversify this in some ways. All right, factors to consider when selling: current value, of course, expected future value. So you don't want to sell it today at 100 when it might be worth 150 a year from now. So that's where our expertise, going all the way back to level 1, our macroeconomic analysis, our microeconomic analysis, our industry analysis, our evaluation of the Fed, our evaluation of the government's fiscal policy, et cetera, taxes, availability of credit, and then prevailing interest rate levels. So boy, this is a great time for the Institute to go ahead and throw a yield curve at you and say, we expect the yield curve to twist in this manner or some other manner. What's the best course of action here? It might be mortgage financing. It might be a donor advised fund. It might be a credit default swap. It might be equity swap. It might be something else. But using the prevailing interest rate levels and those expectations for future yield curves is probably going to help us decide, do we want to sell the property now or do we want to hold on to it? So mortgage financing, this is an obvious notion. But the donor advised fund, what we can do is we can donate real estate and get a tax deduction. All right, let's finish up here on objectives in planning transfer of wealth. So what this does is this kind of will lead us into part 3, where we talk a lot about estate planning. So we need to worry about both tangible and intangible assets. So financial assets, personal assets, real estate, timber rights, and then intangible assets, trademarks. So estate planning, we know, preparing for the transfer of one's estate. We know this, what's the goal? The goal is to die without owning any kind of an asset. We want to transfer that ownership to all of the people that we want to own it. So we need to figure out the legal, the financial, and the tax considerations. So what are the objectives? Maintaining adequate income and liquidity. And so, the one thing, if we don't own any assets, we're still alive, right? We still have to eat. And we still get to go to the movies, and maybe we can go to the Super Bowl or something. So how do we maintain liquidity? Well, before my father died, my sister and I, we did all this kind of stuff. Even though my father's estate was very, very small, but he did not want to pay any kind of estate taxes to our particular community, our municipality. But some things are more difficult than others. But he said, look, if I transfer these assets over to you, how am I going to eat? And my sister and I said, well, you know what, Dad, there's always hot dogs that we can feed you. So maintaining adequate income and liquidity, control over the assets. My dad, he really didn't care about it because he trusted my sister and I. But with family businesses, you've got the grandfather or the grandmother, and then you got the first generation of children, and then you got the second generation of grandchildren. They might not be one big old happy family, and so control of the assets. So that's an important part. You hear about this all the time. Here's your homework assignment, which I know that you won't do. Go watch Dallas from the 1970s and the 1980s about Ewing Oil and the control over the Texas oil wells. Oh, there was huge fighting. It was so much fun to watch. All right, asset protection, of course. We do this a number of ways, but notice that very top there, transfer ownership to a trust or to somebody else. Transferring assets in a tax-aware manner. So this is important. This is all part of estate planning. What we want to make sure that when we go ahead and transfer those assets, that we end up with a minimum tax liability. We want to maintain family wealth. We want to make certain that we have some family members who are going to be in line. And of course, this has to be consistent with our charitable goals. And that takes us through part 2. So what I want you to do now is I want you to go back and, what did I tell you after part 1? I wanted you to take 15 minutes and go through those handful of problems at the end. Now I want you to do it quicker. I want you to do it in 7 minutes. Just to remind yourself of what you did back then. And then when we're done, the final 2 LOSs, we're going to go back and take that test for real. And I don't want you to have your notes. I want you to take those problems as if you were sitting on the exam. So this was fun. We'll have lots of great conversations about managing wealth across multiple generations here in part 3. So thanks for watching, and good luck studying.